Hi, I'm Dave Brinkman, partner with Schneider Wealth Management. And in this segment of Advisor Q&A, we wanted to talk about what we've been talking about with clients, which is, what do I do with my cash? If you need the cash in the next 6, 12, 18 months, let's say you're going to buy a house or you're going to buy a car, those are all, in my opinion, very acceptable reasons to keep money in a money market account or a CD or a treasury, something that's going to be on the short end of the curve, again, earning 5%. The other logical scenario I see where I'd say, okay, that makes sense to keep a larger than normal amount in money markets is, let's say you're going to pay down student debt or some other version of a high interest debt. That also makes sense. And then the final piece, and this is just, again, blocking and tackling cash management, is making sure that you, the investor, are keeping enough in cash just to give you peace of mind so you don't feel cash poor. Because the last thing I want to do as an advisor, or we want to do as an advisor, is have you put every last dollar into the portfolio and you don't like looking at your checking account and seeing it, maybe lower than makes you comfortable. In this first chart here, you can see there has been a tremendous run-up in the amount of assets in money market funds over the last 15 plus years. Some current estimates put the amount of funds or financial assets in money markets at around 6 trillion. And if you add in CDs and short-term US treasuries, that number probably balloons to close to 15 trillion. And in this next chart, it makes sense, right? And so what this chart is showing you is money market yields going all the way back to July of 2006. And what you can see here is basically for the last 15 plus years, there hasn't been much in the way of return in money market funds until you started to see interest rates increase in 2022. And obviously then the corresponding, and you can see there kind of March of 2022 is the near-term low. And since then we've been kind of correspondingly up. And as we sit here today, the chart goes through August of 23. I would say rates haven't materially changed. A yield on money markets we're seeing in that 5.25 range. And so there's been a tremendous flood of assets because investors have said, hey, I like earning 5%. I haven't been able to earn 5% on my money in quite some time. So the logic makes sense. But what we've been discussing with clients is careful that we don't overdo the appeal of 5% in US money markets and kind of get overly concentrated in keeping money too short. There's a lot going on this slide, but what it's trying to show you is the current yield on various US treasuries and other segments of the bond market. That's on the left-hand side of this chart. On the right-hand side of this chart is a hypothetical 1% increase or decrease. And as you've heard Jason Staley, our Chief Investment Officer, talk about before, bonds move inversely to interest rates. Interest rates go up, bonds go down in price. Interest rates go down, bonds go up in price. The conventional thinking right now is that we are likely near the end of the rate hiking cycle that was started in March of 2022. And so what this chart is showing you is what would happen to a 1% increase to corresponding aspects of fixed income investments. But the more likely scenario is that interest rates are likely to come down at some point in the future. And should interest rates come down, that's what you see in the blue graph. So let's just pick on investment grade corporates. Should interest rates go up by 1%, investment grade bonds would be off by that 1.9%. Conversely, should interest rates come down by 1%, you would see investment grade bonds and the shift in their yield go up by 12%. So we would say the more likely scenario is that inevitably you're going to see interest rates cut, and you would see bonds go up in price more than they would go down in price if interest rates were to go up. That is why, that's the conversation we've been having with clients, is make sure we're not keeping money in money markets. Yes, it feels nice to earn 5%, but at some point we are likely to see interest rate cuts, and those interest rate cuts are going to cut into that 5% that you're earning on your money market. The last slide here kind of tries to tie this all together. If we look at capital markets in 2023, money markets paid you just north of 5%. The S&P 500 was up 24% on a price level. If you add in dividends, it was up 26% from a total return perspective. And then if you look at corporate bonds, they were up almost 6% last year, their best return since 2009. But you can see the risk that investors are running over the long term keeping excess funds that really are long-term investments in money market accounts, you're potentially giving up some of the upside that, stocks and bonds have historically afforded investors. I think that's the main takeaway, and that's been the discussion item with clients when it comes to their cash. No problem keeping money market funds a little bit higher than maybe you normally would. Should it be, like we said, upcoming purchases, paying down debt, maybe keeping just a certain amount of cash for financial peace of mind. But any assets beyond that level, investors should really be giving consideration to maybe, adding to their bond exposure a little bit further out on the curve, potentially going into stocks. All of that is beyond the scope of this investment, and that's where you'd have the conversation with your advisor, who kind of understands what your long-term plan is, what your allocation is, what your underlying investor confidence is to be able to take on market volatility. So obviously, to the extent that you'd like to have a conversation, please reach out to us and we'd be happy to talk about this topic with you further.